The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and thank you for sharing your Thursday evening with me. Most of our clients are, of course, in the States and the Northern Hemisphere, but we have a few Aussies and Kiwis down under. Now, can everybody hear me okay? Would somebody please just post in the question box that the volume's all right? How are we going? Can you hear me? Yeah. All right. Okay. Thank you, Andrew. Quick off the mark there. And Don up in Canada. Hello, mate. Yes. Good. Dex is with us. Lovely to have you, Dex. God, Lord, that's great. And Boyd. Okay. So everyone's good. Everyone can hear me. And welcome. We've got, as usual, lots of our old friends here, and quite a few of new ones as well, including some of our folks who've just done tutorials and some who are about to. Hello, Chase. He's my man who cautions me about the dangers of smoking quite correctly. And Don from West Australia is with us. And I had an amazing email from Don the other day about his experiences giving up smoking. Quite extraordinary. Thanks for that. Don Maydell up in Canada. Eric's up in Dubai. Eric and his wife are coming to El Segundo, Los Angeles for the tutorial, which starts in about, I guess it's about 9 or 10 days now. John Barnes also. Hello, John. He's coming. Harold Foose, our gold man from Reading. We're going to talk about gold today, of course, Harold. John Listman, he's doing a tutorial right now. Justin Woolley. Yeah, everyone's here. Marilyn. Hello, Marilyn. Michael Pell. Michael, about time we saw you, mate. Come on over. Mike Midsos, our gun trader, super trader. Mike, you should be coming to LA. I don't know why you're not. Mike Murphy, lots of people here. Goodness me, we've got a big roll-up today. Thank you for being with us. And Terry Roberts over there in Australia. Todd Timmons, my old mate, in San Diego or thereabouts, I think, from memory. He's a great bloke. And Vicky, welcome to you too. So, Bill Ford as well. Nice to have you all with us, folks. Lots and lots to talk about today because we didn't do a tutorial last week and markets are just at very, very interesting position, maybe excruciating position. So I've got a few slides to run through with you. I want to talk to you a bit about the central bank Mirage and for the world that hangs on the every word from the central banks, it's pretty much a waste of time, and I'm going to prove that to you today. Then we're going to just look at a couple of interesting markets, but I really also today want to get on to our major trend charts. We need to drastically update the position that equities have got themselves into, where they are, what the future likely holds for them, which might be quite dramatic. And then, of course, as usual, we need to update the gold bugs with us, who are gold traders, and have a look what gold's been doing and it's going to do. So thank you all for being with us today. Let's move on now and see if we can get this turkey here to move. There it is. I just mentioned our summer tutorial, US summer tutorial in El Segundo, Los Angeles, 24th, 27th of May. Tony D and Eric have both cancelled on short notice, so we have 2 vacancies for the tutorial in El Segundo. If you'd like to become a really serious trader, shoot me an email. We'd be happy to have you there, and we can talk about what you need to do to get yourself there. So we have 2 vacancies. Actually, Tony D's with us today. Tony, I'm sorry you can't make it, but that opens the place for someone else. Let's have a look. Wondering just if Eric's with us today. No, I don't think so. Okay. Tony D. Cold and foggy in Chicago. Well, yeah, I know, mate. Jerry's, of course, our supporting broker lives up there, and he's always pretty miserable about the weather. But it's all right. We're just going into autumn here, Tony. So, of course, autumn, winter here at the Gold Coast is beautiful, sunny, not too hot. I guess the downside for wherever you live is there'll always be a few months are a bit too hot or a bit too cold, but the rest of the time it's very, very nice here. Alan Berrien's with us here. Told me to come over here to Talai. It's a beautiful spot, Alan, right next to Mudgee Bar, next valley over, which you sort of put us onto. So I thank you for that. Let's move on, folks. Let me know if you want to come to the tutorial. There are 2 positions available, and we'll be happy to have you there. There are, see if we can move this along. Here we are. I wanted to just point out the futility of these of people who are interested and follow in great detail what the various central banks around the world are doing. The main ones, of course, are the Fed, the US Federal Reserve in America, the European Central Bank under the control of Mario Draghi, an Italian alumni from Goldman Sachs, as most of them are, the Bank of Japan, and of course in Australia, our own Reserve Bank of Australia. And I just wanted to show you that, in fact, what central banks do. We know what their basic function is to set interest rates and give a commentary on the state of the market and where they're trying to take it and why. The reality is very different. Remember that almost all central banks suffer from regulatory capture, none more so than the US and the Bank of Japan for different reasons. The Federal Reserve in the States is actually owned by the large commercial banks. It's wholly a creature of the banks. And while the banks are the major institutional banks are the clients, the regulatory capture means that the institution becomes a tool of the clients. And that's what happens in almost all sorts of institutional endeavors. We see that all the time in all layers of government. And the Federal Reserve is very much a captive of the big institutional American banks. In the same way, the Bank of Japan is captive to its mercantile clientele, the big exporters. So for them, they've always got a battle to get their currency down, and a fair bit of pressure comes onto the US for the same reason, that exporters benefit from a weaker currency and are harmed by a relative higher currency. And what we have at the moment worldwide is this massive overcapacity that's been built into the system, whether it's coal or iron ore, or in the case of China, anything that can be made by a skilled labour team with very low rates. There are massive amounts of overcapacity flooding around world markets. Oil is just another example. And so this battle goes on that all commercial type governments with commercial clients, their products, are under pressure to work to assist those clients, which means trying to weaken their currencies. And it was really interesting to see that the US Treasury actually came out with an unusual formal announcement 10 days ago warning certain countries, Japan and China amongst them, against using currency depreciation to enhance their mercantile trading position. And that doesn't seem to me a big deal, but to come from US Treasury, it is a big deal, and they're signalling that they're really concerned about that. And of course, the same thing happens everywhere. In Australia, we had a mining boom that was of huge benefit to the miners and not much benefit to anyone else, because the government fluffed the chance to take a once in a lifetime opportunity of massive surpluses and turn it into something worthwhile that would enhance productivity for the country. And they did what most left-leaning governments do. They flushed it down the drain on social initiatives. The right-wing parties are more interested in bricks and mortar and bridges and roads. Left-wing parties are fixated with social initiatives. So I'm not taking a position on one of those or the other. There's probably no need to. Most of you have got a pretty good idea that my politics are slightly to the right of Genghis Khan. But nonetheless, these massive commercial surpluses that the iron ore miners in Australia were creating have been completely and utterly wasted by successive governments with poor management and poor policy. And they too, on the issue of regulatory capture, eventually got captured by the big miners. And there's the most classic textbook example for you MBA types, that the government decided it was going to bring in a carbon tax to try and capture some of the super profits that the mining companies were making. And the majors, BHP, Rio, and the others took on a major advertising campaign against the government. And of course, the government folded because the fact that the belief that governments per se are interested in good government and good policies is largely a furphy. Governments exist for their own benefit, the benefits of their family and their friends. And nowhere is this more evident than in the federal systems. So I hope that hasn't defamed everyone in the federal system. I'm sure there are lots of well-meaning people who don't have the levers of power, but it's in what's happening in America at the moment, the Trump phenomenon, the complete wholesale rebuttal, rejection of all established politicians by the populace is merely a symptom. And it's a pretty good symptom. And I was involved the other day in some discussions with some people who were asking me if I would like to get involved in the political process in Australia. And, I used to feel passionate about these things, but to be honest with you, it's at the stage now that really for our country, and I guess for most countries around the world, nothing short of wholesale revolution, a la Trump, is going to make any difference, because all of these politicians are exactly the same cloth. Their only interest is their own preservation, preserving their perks, their income. The machine works to support them. Public servants are not servants. By and large, they earn a great deal more than the people that they're supposed to be serving. They have all sorts of perks. Superannuation, retirement benefits, way above what any commercial venture can offer. And they're either, maybe both, not very good at what they do and not very responsive. But the real problem is there are just far too many of them. And as we become more and more socialist in our leanings, I leave the United States out of that. You haven't decided to elect Bernie yet. But certainly in my part of the world, we're very much socialist countries, and you have this massive 1 in 3 of the population are actually very privileged public servants, and they work to make their jobs more important and to enhance their stature. In other words, as I try to explain to my children, you can always expect people to act in their own best interest, as I'm not sure if it was Churchill or someone else said, always back self-interest, you'll know it's trying. And that's what we have happening all the time. But moving on to central banks, I had a couple of examples I want to show you. This is the Euro USD chart, and this comes from the last meeting of the European Central Bank back in December 2015. And Mr. Draghi, who is an Italian gentleman, the governor of the European Central Bank, was, as usual, leaked what his aims were and what it was he wanted to do. He said he's going to weaken the euro. In fact, he's been saying this for a while, and he said more than that. He said we stand ready to do whatever we take. Janet, thank you. Some nice lady called Janet says, good on you for speaking out so clearly. Good on you. Thank you, Janet. Most people don't appreciate my comments, but I'm glad you do. One of the nice things of having a captive audience is I can drop these things into your ears, and hope that some of you receive them well. Thank you. Anyway, Draghi's always been he picked up that horrible phrase from the governor of the Fed, the US Fed, the previous governor. Um, we stand ready to do whatever it takes. Well, whatever it takes is with the taxpayers' money. So it's not yours, mate, and you're supposed to be the caretaker of this. So, you have these Reserve Bank / economists, witch doctor types, that they're ready to do whatever it takes. Bernanke was the guy who invented that phrase. You might remember the days, those of you who've been in this business long enough, when subprime mortgages were just starting to collapse. And, but Bernanke, that's not contaminated, this doesn't spread. Very small local problem, he said, not going to affect the larger economy or the larger markets. And we stand ready to do whatever it takes. Well, at the end of that, by the time we had George W. and Paulson and billions and trillions, was it, of bailout funds, we saw whatever it takes means that the whole of the population gets saddled with additional debt to bail out some totally imprudent and hopeless banks. And, of course, the interconnectedness and the corruption of all of that is just startling. But interesting, nobody seems to care terribly much except me. I think it's disgraceful, but nobody else cares. They're happy to see this sort of thing happening, and the journalists roll along with it because, of course, they're subject to regulatory capture as well. These guys are they're Joe Jelke-Peterson, an old Queensland Premier, dead now, used to call media conferences feeding the chooks. And, of course, these are the guys who feed the chooks. So the press wants to keep access to them, be mates with them. And they very rarely say anything other than complimentary rubbish, which is not good for them because it gives them a fat head and makes them think that they're actually doing something for society, when of course they're not. They're just feathering their own nest. But here we are. This was Draghi. This was a wonderful day's trading for us, Daniel Code folks. December the 3rd, and Governor said he's going to weaken the euro. He had this meeting. He came up with all his announcements. You could see the market believed him for the first half an hour, and went down. And then, of course, it'd been on sell signal for about 8 days, but that's beside the point. And all of a sudden, whoosh, it took off and gave us a $3,000 trade. That daily buy signal from the Daniel Code was posted about 20 hours before the ECB statement came out. So you see that markets do what markets do based on analysis of the markets, not always based, in fact, rarely based on news releases. And how this works is that what journalists are paid to do, don't for a moment believe journalists or financial commentators actually know anything about trading markets. They don't. I know a lot of them, and there may be one or two out there who do, but I've got to say I'm yet to meet them. And most of the commentators have a background in economics and those sorts of soft sciences. But what they really are doing is they're fitting the available news to the event. Okay? But you see what happens before the news, they haven't got a clue. But we do. And so we had this daily buy signal posted about 20 hours before the ECB statement. And the market did exactly what the charts told us it was probable to do. That was the high probability side of the movement, and the complete opposite of what Draghi had said he will do and tried to do. And you can see the Wall Street Journal's comment up the top that the reaction was harsh, moving the euro stocks and bond yields in the opposite direction to where the ECB wants them to go. Yet, if you if you're bored, you have nothing to do, have a look at what happens with a 1 minute chart in the 5 minutes before and after Fed releases or central bank releases. The world is full. I say it's the monkeys have taken over the zoo and are now running it. The world is full of people who sit there with these silly 1 minute charts and tick charts, what have you, waiting for the news, and then think they can trade it. I mean, it's just crazy. But anyway, that's what they do. So I guess it makes lots of money for the brokers, and that's that. Now, this is the next one. This is the Bank of Japan. And this happened this year in April, 27, 28, somewhere around there. I'll have it on the next page. And this was the Wall Street Journal's comment that their foray into negative interest rates hasn't yielded positive results. Central bank's arsenal is getting thin. Well, what the Bank of Japan's been all about is trying to weaken the yen against other currencies. This happens to be the US dollar-Japanese yen pair. The bar that is pointed to there, that's the release from the Bank of Japan of their last meeting, the central bank meeting. And they came out with their policies. They said that, this is going to weaken the yen. So this is dollar yen. So this is actually dollar down, yen up. Again, the exact opposite of what the central bank said they were trying to achieve, and the steps they announced to push the markets in that direction. And once again, the Daniel code signals told you that. So this is Canadian, Japanese yen. Don't forget, on these currency pairs, there's very high levels of correlation. So if the yen is going to strengthen or weaken against one pair, the general direction, not the quantitative measure, but the general direction will be the same for all of the pairs. So this is the Canadian dollar, Japanese yen, the loonie against the yen, Boyd, yeah. And same thing, this was this first bar here. I'll just bring my highlighter over so you can follow this a bit more clearly. That's this bar right here. This is the day of the Bank of Japan statement from its April meeting. Let's bring that up on the other chart so I can give you the correct date for those of you who are going to try and follow this perhaps on a recording. Let me see. Canadian yen. Bear with me a moment, folks. Okay, here it is. That is the day is April the 28th this year, 2016. Again, we put up these blue line sell signals. Blue line signals are a bit special because they're the ones I urge you to try and hold the trade. And what we do with the most of our other signals are exit first profitable close, but blue line signals, I urge you to try and hold the trade for a longer period. And what we do is we use a 2-bar trailing stop based on the fast DC stochastic, which you can see at the bottom of this page, the 533 stochastic. And we use a 2-bar trailing stop until the stochastic gets overbought or oversold, as the case may be. And then we go to a 1-bar trailing stop. So this signal was put out a day and a half before the Bank of Japan meeting. And the Bank of Japan said, we're going to, take all the steps we can to weaken the yen. And I had about, a couple of handfuls of emails saying, you've got this Canadian yen pair and all the other yen pairs were the same as a sell, which, if this is a sell for Canadian, then it's Canadian weak, Japanese yen stronger. And I had this array of emails saying, don't you know that the Bank of Japan is said they're going to, they've been trying to weaken the yen for a long time. They're going to take steps again, additional steps to weaken it. Didn't you know that? And I didn't bother replying to too many of them. I think I got sick of it after about 3 or 4 and said, yeah, of course I know that, but we don't trade news. We trade the charts. And in my experience over 30 years or more, the charts are almost always right. I can show you literally a dozen of these situations where central banks have telegraphed what it is that they want to do, telegraphed the sorts of things they're going to say in their statement. All the journalists know about it. It's well spread. All the smarties know about it. and it doesn't happen. Because if the charts are telling you that the Daniel code signals the other way, about 98% of the time the central banks actually follow the Daniel code, which I think is very cool. Do they really follow the Daniel code? Well, they do, in fact. I don't know if they even know about it, though I'm sure they've never even heard of the Daniel code. But the reality is that time after time after time, these Daniel code signals are elected, and then when they're against the expectation of that great unwashed 1 minute 3-tick chart traders, that's when you get these nice big bars. And for this market, we had a blue line sell for April the 28th. And if we used our proper trailing stop technique that I urge you to use for blue line trades, you made $4,000 odd on the short side. And then at the end of that run for 0509, which was Monday of this week, we had a Daniel code blue line buy signal. And look at that. This is what happens here. This bar here, which is going to be 0504, May the 4th, you had target recognition. We had a blue line at 83.015. The low of that bar was 82.993. And that gave you target recognition, which started to set up the blue line buy signal. Then 2 days later, you had this break through the Daniel code blue line, and the rush back to close pretty near at 82.971, and the blue line signal was elected the next day, and it made $1,100 on the way up. So what I'm trying to get through to you is that learning to read charts is, so far as I know, the only sound, consistent way of profitably trading. Reading news, listening to news, reading interesting things on websites doesn't help you with your trading. Now, Sister Sage, who some of you have met at tutorials, when she came to me many years ago to learn Daniel code trading, in fact, I taught her husband, Daryl. It's the second person I ever taught. She'd never seen a chart. She knew nothing about trading. And I'm happy to say she has no interest in financial matters. She doesn't read financial pages. She doesn't read websites. She doesn't read anything to do with trading. She has absolutely no interest at all. And she's one of our very best traders. Why? Because she simply does what I've taught her. She doesn't flavor it with a view. She doesn't flavor it with opinion. She doesn't flavor it with outside noise. She simply does, follows the Daniel code rules of trading. And is one of our very best traders. And you can see why. This is exactly against what the Bank of Japan was trying to get across. This trade is exactly against the short side of the trade. It's exactly against what the Bank of Japan said they were going to do. It's exactly opposite what the market reaction was expected to be. Yet the Daniel code said 30 odd hours before, this is a blue line sell signal. And I think that's extraordinary. And this happens all the time, just constant. So let's move on and see what else we can see from here. Let me find my normal tool, which will be in here. And we can move to the next chart we have here, which is under here somewhere. No. Here it is. I don't think that's the right one. This is where we were. Okay, here's the next one. This is exactly the same thing as I've just shown you. This is the Euro JPY coming from the same day, the Bank of Japan meeting. I was going to show you a few other markets just to show you these things don't happen in isolation. They're systemic. This happens all the time, and because of the correlation through a number of pairs, wherever you see Euro JPY, wherever you see JPY on either side of the equation, the same thing is going to happen. So this is exactly the same thing. if they were trying to weaken the yen, which is what the Bank of Japan has been trying to do for a long time, and their stated object from this particular meeting of the Japanese Central Bank, Bank of Japan, was to introduce more what they call stimulus, which is actually just aimed at weakening the exchange value of the Japanese yen. And what happened? Exactly the same thing. Daniel Code has a blue line sell signal. It's elected. Massive trade. Use your 2-bar trading stop. $2,300 odd on the sell side. Blue line buy 2 days after we're stopped out. $1,400 on the way up. $4,500, about the same on the other one. By not listening to what central bankers and commentators say, by simply perfecting your odds at chart reading. Okay, so now we can move on. We've had a lot of interest. These waterfalls and waterfalls are the ones running down staircases, have been named by Sage as the ones running up. We've had a ton of interest in these waterfalls and staircases from people who've done tutorials recently. I haven't been teaching this for long. In fact, the Waiheke tutorial, I think, was the first time that I really spoke about it in detail. That was in December last year. We've had a lot of interest from our clients, very excited about these people who know how to do them. And I've had 3 or 4, maybe 5, all talking about, this is so great, I'm going to put it on weekly charts, I'm going to put it on monthly charts. Well, look, you can, but the point is that's not what it's designed for, folks. This is the S&P E-mini from October last year. You can see, so this is about 6 months, October, December, for 3, 4, 7 months. Let's say 7 months. And in there you've got 5, 8, 8.5, 9.5, 10, 15 and a bit, $22,000 trading one contract in the S&P E-mini on weekly charts. But the fact is that's not what this is designed for, and I don't understand. I mean, I get this request all the time. I want to slow this thing down. I want to stay in the trades longer. I want to have less trades. That's not the way to optimize your earnings. You have a set amount of cash, capital, that you can invest. When you enter into a futures trade or a spot forex trade, you put up margin. That means that portion of your capital is tied up, and if you're only turning it over, you can see here, looking at the waterfalls and staircases over 7 months, 1, 2, 3, 4, 5 trades. You're just not turning over your capital. Have a look what happens when you do exactly the same thing on a daily chart. Now, I should say for all of you folks, before you get excited and try to run off reverse engineering this stuff, some of these trades are genuine, some of them are fakes. And I do that on purpose because I'm not in the business of wanting to educate the internet for free. These are strategies that are taught to my clients who come to tutorials. They pay a substantial fee to learn these very advanced strategies. So whenever you see me talking about something at a tutorial or that is taught at a tutorial, don't waste your time trying to reverse engineer it, because I put in a number of fake signals, so you can't do that. However, I do not change the dollar. The overall dollar value is the same. But there'll be a number of trades in here that you don't see. But here's the same period of time, basically. This chart starts in December, so it's a few months less. This is just 5 months, and look at the money you've made. 14, 20. I mean, it's like I don't know, 2,300, 8, 10, 11, 12, 7, 13, 14, 4, 55, 14. 20, about $25,500. You just make far more money by trading daily charts. So for those of you who want to just hold positions longer, there are all sorts of very sensible techniques available to do that. But by going out to weekly charts, and some of you even going out to 24-day charts, it looks fantastic, but there's a couple of problems with it. One is that you can't trade those size bars. It's the same with trading the 6-day bars. You can't trade them because the size of the bar is so big that when you take your entry, where do you put your stop? And there are ways of overcoming that as well. But I want to make the point that trying to find something that's sort of, slow and steady and goes forever, not really what futures trading's about. If you want to, you can have a look at stocks and these waterfalls and staircases on charts, on stocks, I should say, are quite fantastic. But make sure you're only looking at very big cap stocks because listing rules, particularly in the States, allow controlling shareholders blocks. And unless they're really big cap stocks with big turnover, they're just too easy to manipulate, which of course is going on all the time. So to those of you who've been talking about stretching out the weekly staircases and waterfalls to weekly and monthly charts, if you want that sort of trading, have a look at how they work on stocks, or come to a tutorial and I'll show you how they work on stocks. And yes, they are fabulous, but you're always back to the same point: is your risk management. Where do I enter? Where's my stop? Where's that dollar risk on entry? So I just wanted to make that point. Deck, you're right. Wage slaves like trades they can do on the weekly or monthly charts. I know, but Deck, that's not really what this game's built for. But I mean, I can show them on stocks. I guess that's why so many people like trading stocks. They're sort of slow moving, and most of the time they're slow and steady, aren't they? Okay, so we obviously, Deck thinks we need more of those. Here's our compliance statement, folks, which I'm always happy to show you. There is a large risk of loss in trading commodities, futures, and spot forex, and an even higher risk if you haven't done a Daniel Code tutorial and don't really know how to trade. So I do recommend to you that you be aware of those risks. Only trade with paper money or SIM accounts until you're confident in your own trading ability and in your ability to execute the trades. And there's a considerable difference between the two. Any of you who have not already had a trial of what we do and you'd like to, you're most welcome. Just follow the banner at the Daniel Code website. There's a banner saying free trial. Hit that. Create a username and password. Email your username to Terry at support@thedanielcode.com, and he will be happy to extend you a 31-day free trial of everything we have at the website, and he can also arrange a 31-day free trial of Trade Navigator charts and software for you. Okay, let us move on and let's talk about some other interesting things that I wanted to share with you. And this is the first one. This is gold for our friends who are gold chaps there. Let me just have a look who was asking about this. David, welcome. David, you're starting your video tutorial on Monday, which will be great. Where is this? Oh, Mac's with us. Hello, Mac, up there in Seattle. I hope you're feeling better, mate. I can't find who I wanted to. Anyway, he's one of our leading gold traders up in... thought it was tomorrow night, says David. Let me check my booking sheets and get back to you, mate. It might be. Let me check, get back to you after the tutorial's over. Anyway, for you gold people, don't forget, this is top of this chart. is gold. This is the continuous contract. And the bottom of the chart is the US dollar index, which is the US dollar, basically not against any particular currency, but against a basket of currencies. It gives us a pretty fair position. And what you might notice is the very, very high inverse correlation between these two markets, which is quite stunning. You can see at this point here that the gold had a little spike up in response to the dollar having a significant spike down. Then we go through this sideways period, and then you get this run up here. This is the dollar getting stronger and gold getting weaker. Okay, so as the dollar is weakening off since December last year, all of this weakening off is a function that's reflected in the inverse relationship with gold, which gets stronger. Okay, so bear in mind, those of you gold traders, it's fine, but those of you who are holders of gold bullion, bear in mind this inverse correlation. And I know some of you are big holders of gold bullion. My friend from Reading's the one I always want to talk to. And you've got this inverse correlation. So those of you who are holders of gold bullion, don't forget you're subject to this inverse correlation that as the dollar gets weaker, the gold price is going up. And you might want to think about a sensible way to hedge that. Okay, let's talk now briefly about currency depreciation and have a look at this. This chart, when it changes for you, which it's done now, believe it or not, this is the US dollar against the yuan, the Chinese currency. Have a look at it. And this is the historical stuff. This is all pegged. It's still pegged, but this is totally, look what's happened. This is dollar weakness against the Chinese yuan. Okay, so let's spread that out. This is a 12-day chart, and this is what's happened since January last year. You've had the dollar strengthening all the way through here. So stronger dollar means weaker yuan. And this is one of the issues that Treasury is excited about. Let's have a quick look what's happening with some of the other major currency pairs. You folks in Canada will be well aware that your currency's pretty much been weakening substantially for a long time. And now the dollar, the US Treasury is obviously trying to weaken the US dollar against all pairs. Let's have a look at the Aussie, which is pretty interesting. This is a real roller coaster, isn't it? We're back here in 2008. We're down at 60, 67, 66 cents, as low as 60 cents. Up through here, this is the mining boom. It's over $1. Absolutely crazy stuff. I'll put the line on to show you how the Australian dollar could ever be worth more than the US dollar is completely and utterly beyond me, but it was a marvelous piece of manipulation or control, or whatever you want to call it, by the Australian government. That'd be the Reserve Bank, because from November 2010 until May 2013, the Australian dollar is worth more than the US dollar. This is a country, mind you, that is entirely dependent, or very dependent, on external capital. And despite what Mr. Trump says, where he thinks you have high tax rates, let me tell you that the tax rates in Australia at 180,000 become 50 cents in the dollar for all the rest. And I don't get it. But anyway, look, it's great fun. Those of you who've been following these webinars will know that we didn't quite have the Australian dollar find its targets. This is the US dollar. This we've been talking about for a long time. This was our target, and this was our 4 seal target up here at 100.83 back in March, and it's now weakening off, and it's trying to hold 93.39 at the moment. And this is in the face of a real push by Treasury, not only to weaken the dollar, but its announcements really a veiled warning to the treasurers of other countries that they will be viewed with displeasure if they're seen as artificially moving the value of their currency, which of course is a lot of rubbish. All currency movements are created by government policy, and all governments trying their best to achieve the outcomes they want. It was pretty interesting that we used to get a whole lot of jawboning from the Reserve Bank in Australia that the Australian dollar was far too high and should be down at 65 cents. Let me show you that. We've got that on a chart here. I don't know why we haven't got all our numbers on this chart. We had a huge display of numbers here before. But anyway, this is the Aussie US. This was its highlights up here through the mining boom. And we've had the consistently since the end of the mining boom, about April 2013, we've had the Reserve Bank trying to jawbone it down. They're very reluctant to reduce interest rates when other states, other countries, the official rate is 0 or close to it. We've been until last week at 2%. And 200 basic points difference is a huge difference for international investors. So the money going into Australian government guaranteed bonds or Australian bonds, government bonds, has been absolutely massive because, of course, they're getting some part of 200-point premium from the countries that are on near zero or negative. They're not really negative. It's a bit of a fallacy. It's an economist's joke. Near negative interest rates. They can buy Aussie bonds, government guaranteed, AAA rating, 200 basic points. And then, of course, you know, the Australian Reserve said, well, you know, we're so surprised with this. The currency should be lower. Guys, it's holding strong because you're holding interest rates up. You know, if you want to really want to see the currency perform against other countries' currencies on a proper basis, match the interest rate. And, of course, they won't do that because Australia, as I said, is dependent on foreign capital, positive foreign capital flows to pay its bills. So that was that. Let's go and look at what's happening here, that on this currency depreciation situation. This is a really interesting picture of what's happened to a commodity-producing country. Australia, of course, produces massive amounts of primary produce and grains and what have you, like Canada, and it also produces lots of mining exports. Oil, not much, bit, tons and tons, biggest in the world of exporters of iron ore, coal, and soon to become, maybe this month, will become the biggest exporter of natural gas in the world. And interesting thing is that all of these things have taken a hit at the same time. Coal prices are down markedly. Demand for coal from China has slipped a lot. Iron ore is down from $100+ to went down as low as $30-something, to now at about 40, 45. Coal, iron ore, gold's holding up okay, and primary production is great. But the two big levers of Australian exports, iron ore, gold, and now natural gas, absolutely getting hammered on price. Those of you who follow these things will know that Peabody's one of the biggest coal mining companies in the world, has filed for Chapter 11, which will give you an idea of how other coal producers are doing. And that might be going to get better because, I see that Hillary said that they're going to close a whole lot of coal mines in America and put all those coal miners out of work. So if Hillary's elected, I guess we can look forward to, Australian miners anyway, can look forward to US miners being put out of work, their businesses being shut down, that she said she was going to do, and that will take a fair bit of supply off the market, which probably means much better prices for South American and Australian coal miners. The good news, folks, is I don't think it's going to happen. It's I think the trend for Hillary is down. Amazing as it seems, and no one's more excited and interested about this stuff than I am, because I think you're going to do in America what we just haven't got the guts to do in Australia, and that's just kick out all of these professional politicians. They're just no good, and I think I told you earlier I was having this conversation with some people who asked me if I'd like to get involved in politics, and had a couple of very nice offers for me, and honestly, the more I thought about it, I had to come to the realization that nothing's going to change. People with the best intentions in the world individually are not going to change the status quo, because the entrenched status quo is for the benefit of the incumbents. And it's what you see happening in America now, this row between the Republican Party, the elites, the established elites, and Trump is actually, they'll frame it as some philosophical debate, which is rubbish. These people don't really believe in anything very much except their own well-being. It's really an argument about the fact that they've got to the top of the tree. They've embedded themselves in a political system that's highly rewarding to office holders, to their families, to their friends, to companies, to anyone associated with them, and they're fighting for their financial perks, and their perks come with a big fat capital P, and that's really what it is. And if you'd think of politics more in the terms of individual self-interest, you'll get a better view of it. Chase this off with their heads. Couldn't agree more. Bunch of bludgers. Anyway, and thieves and liars. Chase, what's more. Anyway, they probably haven't committed the great sin. I know that Donald Trump's never had a cigarette in his life, so he says so. Excuse me. Okay, let's get on to the important markets now, because we're going to run out of time soon. I have a video tutorial for Mike starting straight after this. So we're going to have to finish pretty much at the hour today, folks. Let's have a look at the really big deals here, one of which is the S&P. And we talked pretty much at every tutorial about this, every webinar I should say. And for those of you who are not familiar with this chart, this is the crash low down in March 2009. And for the whole of the period from then until January 2016, this market has been controlled by a Daniel Code trading channel, which some of you know how to draw. And it's interesting that if you asked most people, tell me a bit about the movement of the S&P, they'd say it's random. Of course, it's nothing like random. It's controlled by these Daniel Code ratios, and you can see how at all times it's being controlled by these one standard deviations up and down from the median. The darker blue line is the median. This second line here is two standard deviations, which it went to exactly in October 2011. Since then, it's just worked between the one standard deviation down and one standard deviation up. And up here, we had a 59 Daniel Code time cycle, which often gives us tops. Now, this is not the crash cycle. That's slightly different, but it often gives us tops. And then we saw this correction down into one standard deviation from the mean, which is our first sign of a change of trend. And then eventually, right here, in February 2016, we got a close below two standard deviations from the mean. And that's usually the confirmation, excuse me, that there's been a change of trend. And we told you about that one day after it happened. So what happens now? Well, the 59 we got at the top is not the crash cycle. So I'm not looking for anything dramatic here, other than to caution you that if you go back to the 2000 top and the 2007 top, you'll see how long it takes markets to roll over. But what's happened here is we've got a new Daniel Code trading channel now, and it's pointing down. Okay, so this market is currently in a downtrend. Look where it went to. It went to the first Daniel Code number, the 29.6 retracement of the minor swing. That's down to the 2011 low. And if it's in this trading channel, we expect it to observe the trading channel. And that's what it's done. It's rallied up. It's got to the median. It's got past the median. It's gone to just past, not quite at the one standard deviation from the mean on the down-facing Daniel Code trading channel. Okay, so it's recovered the first. Now then take your eye off that and put your eye on this line going up here, which is one standard deviation from the mean. It's recovered. That's the first thing it tries to do. Now it will try to recover this line up here, which is about 21.94, is the extension of the median of its long-term trading channel. But this, if it fails here, this could be quite dramatic. Okay, so be on your guard. It's in a position, it's done its run up that it should have done. All of this is exactly as we should expect. It's tracking just below one standard deviation from the mean. It's held that for a couple of weeks. It's going to make a burst to try and get back up above one standard deviation from the mean and then get to the median. If it fails, this is where it's going to fail. So be on high alert for that, folks. Just follow the Daniel Code signals. Okay, so that was, I wanted to show you that. S&P and gold we've done. Gold against the US dollar we've done. And currency depreciation we've done. And now we've had a look at the S&P on its 6-day chart. So that's pretty much what I want to talk to you about today, folks. Next one is going to be next tutorial. I'm going to be in America. Today's the 12th in America, 13th down under here in Australia. And I'm going to be going to the States on the weekend of the 21st. I'll actually be teaching a tutorial at El Segundo on that day, so we won't be having that webinar, but we'll fit in one anyway in there somewhere and make sure that we keep you up to date with what's happening in markets. And of course, you will get an email as soon as we schedule the next webinar. So let me just have a look through any questions here before we sign off here. Jim, getting question in the queue, can you discuss whether or not you usually get a TO3 or blue line trade signal in conjunction correlation with the fourth seal? We've had one running in gold to get a reversal signal and as yet haven't had one. You see whenever you read the fourth seal, the last thing in the line will always say follow the Daniel Code signals to get elected, Jim. The fourth seal analysis is quite outstanding, as you know, but you then have to trade it. And when we're using 6 and 12-day charts for analysis, that's important, but you can't trade those bars. The risk on entry is far too big. So you have to follow the TO3 plus signals to get elected. Mr. Matt from Melbourne's with us. Hello, mate. Who else have we got here? Dex has got that. Mac's doing better. Good on you, mate. He's in New York. Mac had a bad turn last year. He's recovering. Being in Theus. I agree, Dave. I don't know what that means, Dave, but anyway, you're happy. That's the main thing. Okay, Janet, thank you. Gosh, Janet's enjoyed the webinar. Killer webinar. Thank you, Janet. I'm glad you enjoyed it. I need to end this webinar now, folks. So thank you for being with me. And for me, it's Friday afternoon. I've got a 2-hour video tutorial coming up with Mike in about 10 minutes. I'll just have time to get a cup of coffee and say good morning to the dogs and cats, and perhaps even Mrs. Needham if she's out of bed by now. She's worked at night on her book writing, and sometimes doesn't get up for a few hours. But anyway, I'll have a 10-minute break and be back with you, Mike, in about 10 minutes. Thanks for being with me, folks, and I look forward to seeing you at the next webinar. If you've got any particular topics you'd like me to talk about in any of these webinars, please just shoot me an email, jneedham@thedanielcode.com. Let me know what it is you'd like me to cover, and I'll be happy to prepare something for you. So thanks for being with us today, John Barnes. I'm going to see you soon, mate. Looking forward to that. Okay. Glad to have you here, and I'll see you in 10 days or so. Okay. Thanks for being with us, folks. Bye bye.